The stock market has been with us for such a long time, it is almost impossible that anyone in the modern world has not at least heard of the stock market. Many businesses rely heavily on the stock market as an indicator of financial strength and financial sector health, or to keep an eye on the competition. It is a vital part of business and company performance. However, the layman usually does not have anything to do with it. It is the realm of the rich and powerful, and only those that need to know and understand it do. The average person only pays attention when the market suffers a crash and plunges the country into recession. The average person is wrong, so very wrong. The stock market is open to almost anyone to make money through trading and investments. All it requires is some knowledge and a small amount of capital, and anyone can use the stock market to make money either through active trading or passive investments. This book is going to teach you what you need to know about the stock market in order for you to begin using it to generate passive income through investments, specifically dividend investments. But first, I need to teach you what the stock market is and how it works. Having a base level of knowledge about the stock market is vital because there are specific words and phrases that you need to know in order to be effective and react to what the stock market is doing. Coming into the stock market with no experience is fine. There are hundreds of thousands of resources available to the newcomer and the experienced investor, such as this book. Seeking knowledge is the first step in making a successful profit off the stock market. You must never feel bad or ashamed about looking something up or listening to someone who may know better. The stock market can be complicated and it moves fast, making active trading a highly competitive arena. But passive investors play the long game. It is no less complicated, but you have the time to make your decisions in a less impulsive way. Taking your time and doing as much research as you can about your potential investment will be your key to success. The knowledge I will be sharing will be in-depth introductions and explanations of the various facets of the stock market before I teach you about dividend investing. Dividend investing requires a base level of knowledge before you can get started, and thus, that is where I will begin. Understanding the fundamentals is always important in anything you do. Music, math, driving, and building all require you to understand the fundamentals before you can do great things with them. This book will teach you those fundamentals so you can chase your dreams and do great things in the world of investments. Chasing the dream. Everyone has an idea of the successful investor, someone who spends hours upon hours, days upon days, poring over spreadsheets, yelling through a phone, dressed in a sharp suit with a cupboard full of fancy whiskeys. That image is archaic. The successful investor can now be anyone. Anyone with a dream and the drive to achieve their dream. Keeping your eye on the prize should be motivation enough to keep making the right investment decisions. Your dreams are what your end goal should be. You should be doing this for you and yours, as your financial freedom depends on your drive and motivation. What lies at the end of the road? What makes you yearn for success? Hold your answer in your mind, keep it there, keep it in focus, and plan to bring it from your mind to reality. Some successful businessmen and investors say that holding an idea in your mind allows the universe to give you what you desire, but that is simply not true. Holding an idea in your mind and planning allows you to take what you desire. The universe does not care. I am teaching you about the stock market. The stock market is hard data and numbers, not universal energy and pseudo-philosophy. Setting your goals is important, but once they are set, you have to put in the work. Chasing a dream requires work. The amount of work it requires depends on how much you are willing to learn. The more you learn, the easier it will be to read the market and make smart and safe investments. Your dream is only ever dependent on you. How much you put in, how much you learn, and how much you are willing to work. When working towards something, you are more likely to succeed because there is a specific goal. Aimlessly wandering around is how you make mistakes, because there is no end in sight. Your decisions are unfocused. This is why you should set your goal early. Knowing what you are aiming for is how you plan. You cannot plan for nothing. nothing is nothing. You will not be successful. You can get started before you set your goal, dedicating all your power to starting your journey with only a vague direction. But you have to remember to focus before it becomes too late, and you are left scrambling when different opportunities start heading your way. Being focused on a dream and end goal will let you pick the opportunities that further you on the road to your goal. Emphasizing this point is important, which is why I'm doing so. Nobody goes into the stock market because they just feel like it. They go in knowing what they want, and they have a plan. They will achieve their goals and dreams because they started ready to finish. And so will you if you pay attention when reading this book. I will arm you with the knowledge to plan for your eventual goal, financial security, and freedom. Your dreams are just a few steps away, and the starting step is right here in this book. Thank you for buying and enjoying this book. When you get a chance, please leave a quick review for us on Audible. Thank you so much. Chapter 1. Intro to the Stock Market. Now we're going to get started on the meat and potatoes. In order to understand dividend investments, you need to understand the basics of the stock market. To that point, this chapter will explain what the stock market is and how it works. The point of this chapter is to ease you in. The stock market can be intimidating, but hopefully by the end of this chapter, you'll have more confidence. What is the stock market? The stock market is actually a collection of smaller markets that facilitate the trading of publicly shared stock, issued by publicly held companies. Stock is also known as shares or equity. Companies put shares up in order to generate capital. This allows them to grow and invest that capital into ventures or facilities. Not all companies issue stocks to the public, but instead sell shares to private businessmen at a higher price. These private shareholders then have a say in the running of the business and decisions that will affect their share price. Public stocks are usually sold once by the company and are then traded among the public on the stock market. When a stock is traded, it is unlikely you are buying that stock from the company. You are more than likely buying from another trader or broker. The stock market has evolved to allow the purchasing of stocks in a secure and regulated way. It's a platform, a middle ground between you and the company. There are thousands of different stocks available, which is why a platform is needed. The companies and brokers put the stock up on the market so all the stocks are in one place. And then investors or other brokers can find the stock they are looking for and buy or sell accordingly. Having all the stock up on a central market keeps things fair and makes it easier to regulate. A company cannot lie to the buyer if the information is determined by the buyers. The market price of a stock depends on the bids, price offered by buyers based on how much they think the stock is worth, put forward on the stock. Stock markets are regulated by local financial regulatory bodies. These bodies are meant to keep the markets fair and prevent instances of illegal trading activities like insider trading, trading stocks based on private insider information. Different regions have different regulatory bodies, so you'll have to do a little research into your local market regulators and any regional laws about stock market trading. Keeping within your local laws is important when dealing with the stock market because regulatory bodies can and will prosecute with severe consequences. The two biggest stock exchanges are the New York Stock Exchange, NYSE, and the NASDAQ. Both operate out of New York and mostly deal with American stocks and companies. Both also deal with European stocks, but in slightly different ways. NASDAQ handles European stocks together with American stocks, while the NYSE's parent company, Intercontinental Exchange, or ICE, acquired NYSE Euronext, which was the result of company mergers in the latter half of the 2000s. Whenever someone thinks of stock trading, they probably imagine the NYSE floor trading. Floor trading is definitely still alive and well, but is on the decline as digital trading is taking over, especially among non-professional traders. Now, floor trading is done almost exclusively by high-volume brokers working for high-powered investors or indices. The NYSE uses digital interfaces and systems now, but NASDAQ was the first electronic stock market when it started in 1971. However, the NYSE has been with us since 1792 and has only grown in importance and size since. While the NYSE is definitely old and important, NASDAQ has had some very important listings on their exchange. In 1980, Apple had their initial public offering, IPO, the process of a private company offering shares to be traded publicly, on the NASDAQ exchange. In 1985, the company launched their own index, the NASDAQ 100, which is an extremely popular index among investors in the technology sector. In 2004, Google held their IPO on the NASDAQ exchange. Google stock is now traded under their parent company, Alphabet, and is worth, at time of writing, just over $1,500 per share. For comparison, Apple stock is worth, at the time of writing, around $370 per share. In 2016, NASDAQ named Adena Friedman as the CEO, making her the first woman to be CEO of a major U.S. exchange. The NASDAQ exchange has led the charge on several fronts and is likely to stay with us for a very long time. The NYSE competes with the NASDAQ exchange through sheer size, which it gained through mergers and acquisitions. Most countries have at least one local stock market that its citizens can trade with. In Japan, the largest local exchange is the Tokyo Stock Exchange, TSE, and usually goes under the name of its parent company, the Japan Exchange Group. The People's Republic of China has 3 independent stock exchanges: the Shanghai Stock Exchange, SSE, the Hong Kong Stock Exchange, SEHK, and the Shenzhen Stock Exchange, SZSE. In England, there is the London Stock Exchange, LSE, which has grown through a merger with Borsa Italiana, Italy's local stock exchange, to be the largest international exchange with 3,000 companies across 70 countries. Germany has the Frankfurt Stock Exchange, FWB, which is one of the oldest recorded stock exchanges, having been founded in 1585. Getting started in trading could very well be easier if you trade in your local exchange before turning your attention to international exchanges. Not only will you gain experience, but you will also grow capital with which to invest in an international exchange. Having the patience to learn how the market can move by observing your local exchange can benefit you greatly before you move on to making investments in larger stock markets that operate on a larger scale. Gaining experience is vital for any form of investment in the stock market. Learning as much as possible from a variety of sources will enable you to make the best decisions with your money. Each source will offer different insights and different opinions in which you can collate to make your informed decision. How does the stock market work? Now that you know what the stock market is, I'm going to explain how it works. The obvious answer is through the buying and selling of public stocks. It works through the concept of supply and demand. Companies supply stocks by listing themselves on the exchange, and investors demand these stocks with the intent to either hold their share in the company to earn dividends or with the intent to sell the stock further down the line when the stock price suits their needs, usually at a higher price than when they bought the stock. The buying and selling of stock, along with the company's financial performance, drives the price of their stock either up or down. The point of doing these transactions on a market is to mitigate risk, not financial risk, but the risk of being scammed or stolen from. The companies want you to buy their stock in order to make capital, and brokers want to sell you stock so they can make a commission on closed deals. Most stock markets make their money by charging fees for trading on their platform. Some investors work through stockbrokers, professionals who have studied and are registered within their country to handle transactions on the stock market. Stockbrokers, or brokers, can have several roles when trading stocks. They can act as a middleman between you, the investor, and the market as a whole. You would explain to them what you want and how much you are prepared to invest, and they would take your money, charge a fee based on the service they are providing, and then invest your money for you. Brokers are an invaluable resource because this is their world. They have an understanding of the stock market that can only come from years of experience, and it is always recommended to use a broker as a beginner. Stockbrokers buy and sell stocks on behalf of an investor, but they would not be able to do this if there were no stocks on the exchange. Investment bankers are the ones who handle complex and large financial transactions, such as mergers, acquisitions, and IPOs. These investment bankers have a deeply complex job and a wealth of knowledge as they deal with financial regulations, hold multiple large accounts from companies worth billions of dollars, and have to keep up to date with the daily movements of the stock market, stock prices, business deals, and international exchange rates. One position that will be important for dividend investing will be the portfolio manager. The portfolio manager is a person or a group of people responsible for an investor's investment portfolio. This means they are the ones to invest the money in order to build profits for their client. The two approaches to this are active and passive. Active portfolio managers try to beat the market by buying and selling stocks in order to make returns. A passive manager will follow a market index in order to maximize long-term returns. Doing your research into available portfolio managers and their performance could be the linchpin to your success with dividend investing. So putting these concepts together, we can see how trading works. A private company decides it needs more capital, so they decide to become a publicly traded company. They approach their bank, who assigns them an investment banker to advise them on how many stocks they should put up and what their value should be. The company registers on a stock market based on advice from their investment banker. Which market they register on depends on which financial sector the company belongs to and how many companies in that sector perform in the different markets. This can be extremely complex, which is why companies use investment bankers, because they understand how to read market indices with niche markets, giving the company the best chance of growing within the market. Once the company has held its IPO and investors can buy the stock, some of these investors would have used a stockbroker or a brokerage firm, may have preemptively bought these stocks in order to sell them to clients or keep for the firm's portfolio. When you see a stock that you would like to buy, you would go through a broker to purchase the stock. When you decide you do not want to hold on to a stock anymore for whatever reason, be it that it has grown in value and you stand to make a profit when it has been traded off, or the price has dropped so far you could no longer recoup the cost of buying it, you would go through a broker again to facilitate the sale. Brokers have changed drastically in the modern age. You can now use a digital broker or brokerage account, which allows you to directly trade on the market. These kinds of brokers still function in a similar way to traditional brokers in that they have brokers on the back end helping make the platform run smoothly and offer indices and various informational graphs or charts to help their users make decisions. Online brokerage accounts and robo-advisors have grown wildly popular over the past decade as computer algorithms become more elegant and accurate in their design. This process of companies assigning public shares, the buying and selling of that stock, holding stock, it all comes together to make the stock market work in the simplest explanation. The stock market goes much deeper with different stocks from the same company holding different implications for the investor. Different strategies depending on which exchange you are trading on, which company you are trading in, which country you are trading from, the country one is trading in being where the market is, and the country one is trading from being the country where the investor resides. The multiple different taxes applicable to the different kinds of trading. The stock market works in such a complex way that explaining the intricacies and minutiae would not benefit a beginning investor. It would act as a barrier to entry that is no longer necessary when dealing with the modern stock market. The different kinds of stocks. Following on from how the stock market works, we need to explain the differences between the various kinds of stocks. Not all stocks fall into the same classification, and even stocks within the same classification or sector perform in wildly different ways. Classifying stocks is a method brokers and investment bankers use in order to make tracking the market easier. It's easier to see how the healthcare sector is doing if all companies dealing in healthcare products are together in one category. It is similar, in a way, to music genres. You are more likely to find a band or artist within a genre when you search by the genre. It's the same for stocks. Categories help investors find what they want quicker and easier, allowing investors and brokers to react to the market in more significant ways. The two main classifications of stock are common stocks and preferred stocks. Preferred stocks will be very important to this book, as they are the stocks that pay dividends to the shareholders. Preferred shareholders usually do not have voting rights associated with them, and they fluctuate in value a lot less than common stock, but their dividends are more stable. Owning common stock is more in line with the traditional view of a shareholder. Owning common stock means you own a stake in the company and therefore you possess voting rights. How much voting power you have within the company is dependent on how much company stock you own and which class of stock. Common stock can be further broken down into different classes if the company has decided that they want to have dual-class stock. Some even have more than just two. The difference in this case is that one class could have more or less voting power than the other, making the stock more valuable and expensive. These multiple class stock structures are usually in place so that the founders and high-ranking officials within the company are able to retain majority ownership and voting power within the company. They do not want an individual or set of individual investors to make massive decisions about the company's direction, so they hold on to as much voting power as possible while still selling common stocks. Common stock also grows alongside the company, so if the company does well, then the value of common stock goes up, giving the shareholders the opportunity to sell the stock and make a profit. But if the company does not do well, the price will drop and shareholders can potentially lose that investment. If you buy stock at $100 per share and you buy 2 shares, and the company performs poorly, your 2 shares will diminish in value, and you stand to lose that $200. If the company does very poorly and their stock is valued at $20 per share, and you have to sell because those shares are just weighing down your portfolio, you have lost $160. 40 minus 200 equals 160. Another category of stock classification is market capitalization or market cap. A company's market cap is how many judge the size of a company. The higher the market cap, the bigger the company. Market caps are the total value of all a company's stocks, common and preferred. If it is stock issued by a company, it is included in its market cap calculation. The formula is shares multiplied by the stock price. If a company has issued 1 million shares and those shares are worth $100 each, then the math looks like this. 1 million times 100 equals 100 million. This company's market cap is 100 million. This is how investors and brokers can make decisions when evaluating risks when buying stock. Market caps are broken up by a company's size: large cap, 10 billion or more, mid cap, 2 billion to 10 billion, and small cap, 250 million to 2 billion. There are 2 special market cap categories: micro cap, under 250 million, and mega cap, 200 billion or more. The higher a company's market cap, the safer an investment they are. This comes from a kind of too big to fail idea. The bigger the company, the more money they have to weather any kind of financial strife. It is inconceivably improbable that many mega-cap companies would run out of money. The other 2 important classifications are growth stock and value stock. Growth stocks are stocks from a company expected to grow rapidly in market value. Brokers and traders will buy growth stocks with the full intent to sell off the stock once that rapid growth has occurred and before the company's stock price normalizes. They sell as close to the peak value as possible in order to maximize profit. There is considerably more risk involved with trading in growth stocks because they are classified based on a prediction. The brokers and investors look at the company performance, see its performance is on the rise, and predict they will have a period of rapid growth. And that is what they try to take advantage of. Company could very easily not experience that rapid growth. That's the risk. Some of the biggest companies in the world, like Amazon and Alphabet, Google's parent company, started as risky micro-cap growth stocks, but are now safe mega-cap value stocks. Value stocks are stocks with a value that is on a slow but steady rise instead of a rapid growth period. Value stocks are generally safer and do not fluctuate in value nearly as much as growth stocks. It is plausible that a growth stock will become a value stock, as has happened with companies like Apple and Amazon. They had a period of rapid growth, which they managed to sustain, leading to their prominence on the stock market. Chapter 2. Introduction to Dividend Stocks. The moment you've been waiting for. Dividend stocks. Dividend stocks are a form of value, preferred stock. Thanks to the first chapter, I do not need to go in depth on what those terms mean. Dividend stocks and dividend investing are a very popular investment plan that everyone who wants financial security or a retirement plan should be investing in. A lot of career paths offer retirement plans as a benefit to employment, and most retirement plans take advantage of dividend investments. Income investment plans are another example of dividend investments, but employ a very specific strategy to how those dividends are paid out. I will explain how these strategies work and what they are taking advantage of. What are dividend stocks? A dividend stock is categorized as any stock that pays a dividend to the shareholder. Dividends can be explained as your share in the company's profits, which you earned through your financial investment in the company. Companies try and leverage this financial support in different ways to make you purchase more stocks in the company through reinvestment plans or exclusive deals on stocks. Dividend stocks require a bit of research on the part of the broker or investor, as some stocks do not pay out dividends, pay them on different schedules, or have different policies regarding dividends and shareholders. Companies pay out dividends based on the decisions of the board of directors. They are a way of rewarding investors, but that does not mean that they are required or obligated to pay out dividends in any way. Alphabet is one of the largest companies in the world, and it does not pay out dividends. Alphabet as an entity made the decision to reinvest profits back into the company and into various research and development projects. Alphabet operates using a different philosophy to many other big companies. They have stated in their company mission statement, written by co-founder Larry Page, "Google is not a conventional company. We do not intend to become one." Dividends are paid out to shareholders on a regular schedule determined by the company. Knowing when a company pays out dividends is important when investing in dividends for a passive income, because that will affect your budgeting and accounting decisions. The most common time companies pay out dividends is with financial quarters. Financial quarters are 3-month periods of time that inform financial activities across the world. Many financial planning takes place over quarters. Most financial planning takes place over quarters to keep in line with when companies need to perform reports, taxes, overheads, and many other facets of business. Knowing how the companies you are investing in break up their fiscal year will be very important, again, for budgeting and accounting purposes. The standard fiscal year follows the modern Gregorian calendar, with the quarters being Q1 from January to March, Q2 from April to June, Q3 from July to September, and Q4 from October to December. Financial quarters are important when discussing dividends because many companies pay out dividends quarterly. So they take the agreed-upon annual dividend and pay out a quarter of that amount at the end of each fiscal quarter. Some companies will pay out a single dividend at the end of the fiscal year, or they will pay it out monthly. Doing your research into the company's dividend policies will affect which stocks you decide to invest in, because that is where you will find this information. When companies pay dividends, it can mean many things. If a company did not pay dividends because it was not yet profitable enough to pay dividends to investors, and then starts paying out dividends, that can be a sign of financial stability and growth. This will draw the attention of potential investors and brokers who notice this change in the company's share policies, and they will make moves to invest in that company early so that they are able to reap the rewards of being an early investor in a growing company. Larger companies usually pay smaller dividends because of their size, which is why some investors do not invest in those companies with the goal of making income investments. These larger companies usually have more expensive stock, but investors who invested early would have bought that stock at a much lower price and earned dividends over years or even decades, making their investment extremely profitable, especially as now they could potentially sell their stock that no longer pays decent dividends and make a tidy profit off the sale. A lot of seasoned investors and brokers will tell you that they have two kinds of stocks. Stocks that they buy and sell off in an active trading strategy, and stocks that they buy and hold because they collectively pay out a substantial dividend. If it is something that professionals in the field are doing, why would you do any different? Dividend stocks are the number one choice for passive income in 2020 and have been for decades, and they will continue to be profitable for casual and professional investors alike. How do dividends work? Dividends have 4 major dates that affect how and when they are paid out to investors. Knowing what these dates are for each business your stocks are from is something you need to pay attention to when buying and selling dividend stock. These dates are the declaration date, also known as the announcement date, date of record, ex-dividend date, and payment date. The declaration date is the day on which the board of directors announces what is happening with the dividends, how much is being paid out, and when. The date of record is much more important to dividend investors, as this is the day that the company goes over its records and determines who is eligible for dividend payouts. You have to hold dividend stocks in the company from at least 2 days before the date of record to qualify for that dividend payment. You have to hold them for 2 days because the day before the date of record is the ex-dividend date, sometimes referred to as the ex-date. This day serves as a kind of cutoff date for dividend investors. Anyone buying stocks on the ex-dividend day is buying those stocks ex-dividend or without the dividend. The dividend for that stock would be paid to whomever held the stock on the day before the ex-dividend date. This happens because stock transactions take 1 business day to come to completion. The next date in the cycle is the payment date, which is, of course, the date on which dividends get paid to qualifying stockholders. This date usually occurs within the month following the ex-dividend date, as the business needs to calculate a lot of figures and sort out logistics and applicable bonuses or stock benefits. The price of a company's stock has been known to take a small dip on the payment date to reflect dividends being paid out. Some active investors use this small drop to buy the stock at a better price as they buy low and sell high. Which specific days all these dates fall on are more completely dependent on the company's dividend policies. As I've mentioned before, doing your research into the policies of the companies you are invested in is very important. I cannot emphasize enough how important doing your research is. I can explain the basics, but to take advantage of my guidance, you must do your due diligence. The next step in the process is the actual payment of dividends. In the past, when the stock market was still a very physical market, investors used to get a check in the mail from the company, or their dividends would be reinvested, which we will go into in Chapter 5. In the modern day, the payment still comes in the form of a dividend check, but it is handled digitally, as with most banking these days. In America specifically, companies use a clearinghouse known as the Depository Trust Company, DTC, parented by the Depository Trust and Clearing Company, DTCC. The DTC offers various services to corporate America in regards to stock trading. They were established in 1973 after the need for a separate handling entity was realized in the late 1960s because the NYSE had grown too large to handle the volume of trades. The DTC handles a lot of back-end operations, such as trade settlements and dividend services. For us, the important aspect is their dividend services. The company issues the dividends to the DTC, and the DTC takes that amount and distributes it to brokers and shareholders. The DTC uses automated systems to handle the calculations and distributions of this money in order to minimize risk, human error, and exorbitant costs that would come with dealing with massive sums of money. To give an idea of the scale of the volume we are discussing, in 2008, the DTCC announced that it had cleared and settled securities transactions that exceeded 1.86 quadrillion. They are a massive part of the chain, and the modern stock market simply could not function without them. The DTC does not only operate within America. They distribute and hold securities to and from 131 countries around the world. It is nearly impossible to do anything on the stock market without dealing with the DTC in some manner. Once the DTC has distributed the dividends to your broker sends that money on to you. This is how dividends work. Once that money has reached you, you have successfully made some passive income. The first few dividend payments will likely not be a large sum, as you are just starting out as an investor. The point is why several brokers and market experts recommend reinvestment plans at the beginning. Letting your investment grow over the first few years will increase your dividend payout over time. We will cover this more in Chapter 5. Your options, now that you have your dividend payout, are to spend it as you see fit. You can buy different stocks for active trading, buy more dividend stocks, whether that be into the same company or a different company in order to diversify your portfolio, or use that money in your personal life. This is the empowerment of dividend trading, building toward a point where you no longer have to consider reinvestment when dividends are paid out, as you have set up a healthy, stable dividend stock portfolio. Chapter 6. The idea behind using dividend stocks as a source of income is to invest in stocks that pay out regular dividends to shareholders. Only receiving dividends at the end of the fiscal year does not help you achieve a passive income. That is more of a yearly bonus. We're looking for quarterly or monthly payouts from a diverse portfolio in order to maximize your dollar payout. This is how retirement plans function, as we will go into in Chapter 5. After initial investments, the aim is for the dividend payouts to cover the costs and fees involved while still paying out enough to qualify as an income and not an aside. This does take a little time. Dividend investing requires patience, but that patience will be greatly rewarded. Discussing and communicating with your broker, if you have one, your goal with dividend investing will help them make investment choices that will lead to that end. On the other hand, if you are going at it alone, you'll have to work out the math. You need to keep an eye on the stock prices and your dividend yield, especially on the declaration date. You'll take the dividend yield, multiply the dollar amount by the number of dividend stocks you have with that company. You will do this with each company and then add all the totals together. Companies may have different payment dates, and you should account for this in the calculations. Using a broker or online tool set to assist in these calculations is a good idea if you do not have experience in finances or investments. These equations can get very long very quickly, especially as your portfolio grows and more companies need to be kept track of. Important factors related to dividend investing. In this part of the chapter, I'm going to highlight certain concepts and points that you, as an investor, should be mindful of. Some of these points have been mentioned or explained in prior chapters, while some will be discussed and explained in the coming chapters. This section is to reiterate these points to prepare you for the deep dives coming up and for you to reference once you have finished the book and are taking your first steps into the world of dividend investing. Take these ideas into consideration when researching and making your decisions. Not all companies pay dividends, and that is fine. Companies that pay dividends with a lower dividend yield are on average a safer investment than companies that pay a larger dividend yield. Low yields are indicative of a healthy company whose stock usually has a higher value. Companies that do not pay dividends are not necessarily bad investments, but they are not what we are looking for. We are looking for dividends that offer growth, which will come from a lower dividend yield on high-value stocks that have shown an upward trend. Collecting multiple growth stocks that pay dividends in your portfolio is how you make good passive income. Chasing high-yield stocks is a dangerous game because these stocks are usually very volatile and you are more likely to lose your investment on these stocks. These kinds of dividend stocks are typically used in the sometimes risky dividend capture strategy. Dividend investing can be called a strategy in and of itself, and a very good one. It is not recommended to go searching for special dividend strategies that claim the ability to make massive profits in a short period of time using dividends. These carry massive risks, and not just to that investment. They could end up affecting the rest of your portfolio in a negative way. Having a calendar with important dates marked down helps you keep track of events, the start and end of financial quarters, declaration dates, and payment dates for different companies. If you have a stock that you are tracking the performance of, it could help to keep track of its price on a separate graph or make a web bookmark of an online spreadsheet or graph. Finding and making use of resources will make dividend or active investing an absolute walk in the park. All information about publicly traded stocks is publicly available to ensure fair trade. There are probably thousands of websites that offer insight, guides, and up-to-the-minute market tracking. Finding one that suits your needs will only benefit your decision-making. As an example, I have said that high-yield stocks can be volatile. And let us say that you do not want to take that risk. Let us say that you have a $100 budget. You can filter stock lists online by dividend yield, low to high, and then filter that list by stocks under $100. The resulting list will be stocks that have a low yield and are under $100 per share. You can then sort this list to show you the lowest yield stocks first, or the most expensive or the cheapest first. Almost all online resources will have some form filtering and sorting option, so keep an eye out for an options or filtering icon when going through online resources. Doing research into companies before you invest in them is always sound advice. You should always look into their performance over the past fiscal year and the years leading up to the current fiscal year. If you notice a large drop in stock price at a point in their recent history, you should look into that. Find out what caused the drop. As an example, if you were to look into stock charts from March 2020, you would notice a massive drop across all sectors. Doing a quick search online will reveal this drop was a result of the COVID-19 global pandemic. Almost every country in the world went into some form of lockdown and closed off borders. This completely shut down the tourism and hospitality industries, hampered international trade, and raised financial tensions as many lost their jobs because their industry was too heavily impacted by the lockdowns. Standard & Poor's 500 Index, S&P 500, tracks the performance of the largest 500 publicly traded U.S. companies. If you look towards the end of February, you can see the beginning of a decline leading to a steep drop starting in March. This time frame has been dubbed the 2020 stock market crash, and at the time of writing, the market has not completely recovered. National and global current events play a big role in the stock market. What is happening inside a company matters to the shareholders. Being aware of the news surrounding the companies you are invested in is of utmost importance. Staying informed is how you stay ahead of potential losses. If you are investing in a company that is dependent on a limited resource, you are playing a dangerous game. A lot of people began investing in specific healthcare companies when the COVID-19 pandemic started shutting down countries because they believed that the massive increase in demand for specific healthcare products would make them a lot of money. And it did, but for a very limited time and only for a handful of companies. Dividend investments are about the long term, the late game. They are not about investing in potential cottage industries or sudden booms in specific industries. Enlisting the help of a financial advisor if you feel the need will not hurt in the long run, as it could potentially save you a lot of money in the future. Ask your broker how they feel about certain current events and how that would affect your portfolio. They are there to help and to give sound advice. Chapter 3. Dividend Yields. One of the key factors when deciding on which dividend stock to invest in is the stock's dividend yield. I've mentioned the yield before, but did not explain what it is or how it works. I did that because I believe it requires its own chapter to be fully explored. Dividend yields are how investors and brokers determine if a stock is worth investing in. On their own, dividend yields are a little meaningless. You need to look at dividend yields as just one part of identifying valuable stocks. That is the core of this chapter. I will teach you how to identify, calculate, and use dividend yields to assess value. Identifying dividend yield. When a stock pays dividends, they express that dividend as a dollar value. Most stock information sites have the dividend yield there on the web page, but if you only look at the yield percentage, it is meaningless. You need context, and you need to understand what that percentage means. For this explanation, we will use a hypothetical stock. This stock is worth $50 per share, and this stock pays an annual dividend of $1 per share owned. The calculation for its dividend yield is, expressed in the market's currency, in our case US dollar, expressed as a percentage. This is the very basic math behind dividend yields. Because stock prices fluctuate hour to hour, the yield changes nearly constantly. It is also only an estimated percentage, as the board of directors may change the dollar amount or eliminate dividends if they so wish. This is how dividend yields play a part in the overall assessment and why they are not the single determining factor. You look at the yield, see it as a small percentage. 2% would generally be classified as low yield. And then you would look at the company's history of dividends and how the yield has changed over the years. Dividend yields work in what is known in mathematical sciences as an inverse proportion. As one value increases or decreases, the other value will increase or decrease opposite to the first value. Value A increases, so value B decreases, and vice versa. If we look at our yield equation again, now that the stock price has decreased, the company is losing value and could potentially become an unsafe investment. We can see an increase in the dividend yield. I must emphasize again that this is an extreme simplification of the math involved, but it serves our purpose. You can see by comparing the two equations that as the stock price has dropped, the yield has increased. On our small scale here, it does not look that bad, but on the real market, these small percentage changes over time can indicate either a failing company or a company on the rise. If we look at our hypothetical company's dividend history and we see their dividend yield has decreased slightly year on year, but they have consistently paid dividends each year, our hypothetical company could be seen as a safe investment. The decrease in yield means the stock has grown in value, and looking at a separate chart displaying their stock price year on year at the same time will help in that assessment. Let us put this math into a real-world setting by looking at Toyota Motor Corporation common stock trading with the ticker symbol TM. The ticker symbol is the unique set of letters that identifies a company on the stock market so that investors can make trades easier and quicker. Figures are accurate as of July 31st, 2020, and are from the official NASDAQ website. The current stock price for TM is $119.34, and the current annual dividend yield is 3.965. According to our equation, which I would encourage you to try with these figures, the dividend yield is 3.32%. In the real world, this percentage is rounded down, and according to the NASDAQ, the current yield for TM is 3.2%. The records available on NASDAQ show TM's dividend history back to 2013. TM has been consistent in paying dividends with a fairly consistent yield since 2013, and this can be indicative of a healthy company and a safe investment for dividend investors. This illustrates how a dividend yield helps inform investment decisions, but does not make or break the decision. You use the dividend to identify a safer investment, and then you do more research into the company. As an example, if TM had a 3% dividend yield, but their dividend history had gaps, you might want to think twice about investing. Doing extra research into why no dividends were paid during that time, or what the company policy on dividends was at the time compared to what it is now, can help you make a decision. High yield versus low yield. Let us imagine another hypothetical using TM as an example. If TM's dividend yield showed an increase over the past 7 years as opposed to remaining stable, but the cash dividend amount does not change, This would indicate a decrease in stock value, prompting the question, why? What has happened to Toyota to cause their stock price to drop? Should you sell off your TM stock, or is this drop part of a pattern their stock has displayed over the preceding years? Referring back to that image of TM's stock price over the years, we see they tend to experience a drop in stock price at the beginning of some years, including at the start of 2020. So a sudden increase in dividend yield would not be an immediate cause for alarm. Stock prices have a tendency to rise and drop after all. But another scenario would be the price dropping well below expectation. The stock price has not dropped below $100 since their 2013 rise in stock price, causing the yield to rise dramatically. Doing some research could uncover that the company is experiencing turmoil. Maybe they released a vehicle that was greatly underperforming financially, and that would be a reason to reevaluate your investment decision. Keeping track of stocks with higher dividend yield can be a viable strategy in finding emerging investment opportunities. Look for stocks that only have a few years of history of paying dividends and ensure that their dividend yield has been decreasing over the years. Let us say their dividend yield started at 25%. Any dividend yield over 10% can be considered high yield. And over the financial quarters, their yield has dropped steadily to the point where it is now 10%. Looking at the history of the company and the products and services they provide will inform your decision. But just looking at their change in dividend yield gives us a preliminary hint that this might be a stock worth investing in before it grows too expensive. This is the balance between high-yield stocks and low-yield stocks. Low-yield stocks are, on average, a safe investment, but can require more time reinvesting to start paying out a decent passive income. Higher-yield stocks carry more risk, but if you do your research or if your broker knows their stuff, they can start paying a decent passive income a lot sooner than the more obvious, safer option. But here comes a caveat with dividend yields and dividend investing as a whole. Dividend investing is a slow process that requires multiple stocks and diversification. If you have been thinking up to this point that these numbers and amounts are rather small, it is because they are. Yields, be they high or low, are quite small amounts of money. This is why professional stockbrokers, investment bankers, and career businessmen all preach the same message: diversify. Holding one stock in one company will never make you a solid passive income. To make the best of a dividend yield, you need to hold many stocks in different financial sectors, and I will go deep into this in Chapter 6. Allow me to break down the difference between high and low yield stocks using some more simplified equations. For the sake of simplicity, we will be using one imaginary stock that is $100 on the open market and is held for 10 years. The annual dividend and dividend yield are $5 and 5%. If these numbers stay around the same and the company continues to pay out $5 annually in dividends, and you only hold one stock for 10 years, at the end of those 10 years, you will have made $50 off that initial $100 investment. You can choose to sell that single stock on the open market for $100, and you now have $150. But let's say that the value of that one stock is increased, and let us say that the company started paying a $10 dividend 5 years in, but the yield has stayed the same. At the end of your 10 years, you now have made $75 just off dividends. $5 times 5 plus $10 times 5 equals $25 plus $50 equals $75. Now here's where reinvestment can come in. Instead of collecting dividend checks, you might be able to opt into a dividend reinvestment plan, more in Chapter 5. These plans reinvest the cash you would have gotten, increasing the number of stocks you have from that company. This, in turn, will increase your payout amount when you begin receiving checks, as you will not receive dividends from one stock held over 10 years, but instead the number of stocks you own will steadily grow for the first couple years, your dividends paying for the extra stocks. Now your dividend total at the end of the 10-year period will exceed your initial $100. On the other hand, let us imagine you bought a stock that is $100 on the open market, but this stock's dividend and dividend yield are $25 and 25%. Holding the stock for 10 years will equal to $250 in dividends alone. But a yield of 25% is not sustainable, and the business endured some financial struggles. For the first 3 years, all is well, and you made $75 on your dividend so far. But the company changed their dividend policy in the fourth year and now only pays $5 as their stock price has dropped down to $60 a share, making their dividend yield 8.3%. In the fifth year, the company decides they can no longer sustain their growth while paying out dividends, so they eliminate dividends altogether, making your total earnings from these 5 years only $80. The company might reintroduce dividends at a later date, but this is the dividend history I pointed out earlier. A steady dividend over a longer period is better than an erratic dividend over a short period. This second hypothetical company could actually do quite well if what they are selling or the service they provide is very valuable, and if they are able to achieve growth while maintaining high dividend yields. It could be a fantastic investment. All investments carry some risk, but doing research into the company is how to tell the amount of risk. Researching companies whose dividend yield is very high or very low is how you make sound investment decisions. I can never stress this point enough, and I will continue to repeat it. Researching companies you want to invest in is important. If the company has a high dividend yield, the stock price is moderately priced, and the service or product they provide is one that is in demand and will remain in demand for years into the future, then that would be an investment worth pursuing. If the company seems to be providing a service or product that people are already starting to drop off on, maybe do not pursue it. Chasing dividends or the in thing leads to financial ruin. If a company comes out of nowhere making grandiose promises of rapid growth with their revolutionary product or service, steer clear. They are driving directly off a cliff that will make them a lot of money, but not investors. It is highly unlikely that you would see these kinds of companies on a stock market, but these kinds of companies would approach investors directly, offering dividend yields of 30% and higher, while quoting statistics along the lines of Microsoft, one of the largest companies in the world, only paying a dividend of around $2 with a dividend yield of only 1%. To the average person, they find this statistic very compelling because they simply do not know how dividends and dividend yields work. This is how high yields can be used to mislead people who unfortunately do not know any better. Doing research into how investments work, such as this book, is how to avoid misleading investment plans. While we are still talking about high and low yield, it is important to get a feel for what a normal dividend yield might be. Simplified math is great at helping someone understand how dividend yields function, but it is not realistic. This is why I use Toyota as an example, to illustrate how the theory gets applied in the real world. I am now going to give real-world numbers that are publicly available from any market website and are accurate as of July 2020. And for the sake of simplicity, we will be using a single source for our information, Yahoo Finance. But because this is the stock market, these figures will be the same even when using different sources because numbers do not lie. We are going to look at a mix of companies from different sectors to help broaden the example. First, we'll look at McDonald's. McDonald's is one of the largest fast food chains on the planet and is synonymous with the term fast food. McDonald's started as a single restaurant in the early 1940s and has grown to more than 36,000 restaurants in over 100 countries. McDonald's stock is currently trading at around $194 with a market cap of $144.5 billion, and their dividend yield is sitting around 2.56%, with their annual dividend at $5. McDonald's stock may look a little pricey at nearly $200 per share with a low dividend yield, but that is a good indicator that this stock is stable. The only recent concern over the past 6 months was the market crash back in March, but their stock recovered well enough and they are on track to maintain their dividends. The next company is Intel. Intel is the leading producer of semiconductor chips. Semiconductors make up CPUs and computers and allow technology to work as quickly and as efficiently as it does. Without the innovations made by Intel, it can be speculated that other massive companies like Microsoft would not be where they are today. Intel stock performance helps to illustrate a point from earlier in the book, too. Intel is trading at around $47 and has a dividend of $1.32 with a low dividend yield of 2.75%. They had a dip in March, as did everyone, but they have a second dip quite recently. This is due to the news that the production and distribution of their next-gen chips has been delayed due to the COVID-19 global pandemic. Several industry sites are claiming this would be a great time to invest, as their stock price is guaranteed to rise rapidly once these chips hit the market. And that would be a safe prediction, as Intel chips are in home computers all over the world. Low yield, stable dividends with guaranteed growth. This is an example of a buy stock, as in buy this stock. Clearly, by the time this book has been published, the market will have changed. But go look at where Intel's stock went. Did it grow? Would it have been a good idea to invest? Did it continue to drop? Research will tell you how situations like these play out and help you identify similar situations among other companies you have an eye on. The next company is one you might never have heard of, but should watch out for. NetEase is a Chinese internet technology company. They provide several online services in China, including e-commerce, instant messaging, music streaming, and video games. NetEase is a massive part of video games in China, thanks to their partnerships with Mahjong AB and Blizzard Entertainment to bring Minecraft and World of Warcraft, two of the most popular video games ever, to China. NetEase's stocks have experienced a period of growth for years up to this book being written, and they only show signs of expanding, making deals with various companies to develop games based on licenses like Marvel and The Lord of the Rings, along with original IP. They have a steady low-yield dividend and a high share price. The next company is a real estate investment trust, REIT, which is a company that owns, finances, and operates income-generating real estate. Some REITs do all of the above, and some focus on specific kinds of real estate. But the main point of REITs is that their properties generate income and profits. HealthPeak Properties is one of the REITs that specialize in a specific kind of real estate, healthcare. They own, operate, and develop properties specifically for life sciences, senior housing, and medical offices. HealthPeak Properties is a good example of a cheap stock that offers a high dividend yield. REITs are known for being a very sound long-term investment, as they offer a steady dividend year on year. Investing heavily in a REIT such as HealthPeak Properties would not break the bank, but has the potential to grow as they have done over the past 2 decades. Chapter 4. Selling Off Dividend Stocks. In this chapter, I'm going to explain the multitude of reasons you could have for selling off dividend stocks. Dividend stocks are still a liquid asset at the end of the day. Liquid assets are defined as an asset that can be easily and quickly converted into cash, just as with any other shares. When considering selling off excess dividend stocks, you do need to consider all possible factors. You do not want to sell off a dividend stock simply because you have earned back your investment. Once you have earned back your investment, that stock is now generating pure profit. Why would you sell off an asset that is now pure profit? Let us discuss. Why would you sell? There are several possible reasons to sell off dividend stocks. Each can have merit, but laying out different possibilities and weighing up your options will lead to better decision-making and potentially more profit off the back of the deal. Not each pro and con have the same weight to it. Some are clearly more severe or require more attention or deliberation. Trying to keep a clear head amidst important financial decisions can be hard, but getting emotional when dealing with stocks does not end well. It might be hard, especially when a company has done something that has caused you to personally lose faith in them. To circle back to Ubisoft, you might have lost faith in the company when the sexual misconduct accusations were made public. It is not good for company public relations when verified stories of the mistreatment of workers become public knowledge. So stockholders might feel inclined to sell off their stock with the company so as to not be affiliated with them. This may be a moot point, as Ubisoft does not pay dividends, but it stands as an easy example. The company did something morally wrong, and this affects public goodwill. The stock price takes a hit, and public shareholders sell off their stocks. Simple enough, but these shareholders stand to make a loss in this, as the stock price dropped due to the controversy. I understand not wanting to back a company that you no longer morally agree with, but we are using dividend stocks to make money, and money is an emotionless business. The executives from Ubisoft were not fired because they did horrible things. They were fired because keeping them on would sour public perception and potentially lose the company money. So we have our first reason to sell. The company has done something that you are not emotionally comfortable with, and that is fine, but you will need to exercise patience when deciding to sell your dividend stock, as we will go into in the next part of this chapter. Another very valid reason for selling off dividend stock is liquidation. There are points in life when things can get a bit out of hand, plans go wrong, and you might need an influx of cash to deal with whatever it might be. An example, medical emergencies can be absolutely devastating, and American health insurance is a minefield that I will not be going into. But suffice it to say that it can be inconvenient when you need it the most. This is where having liquid assets and stocks can bail you out. If you have a healthy portfolio, you can use it to pay off emergency expenses like medical bills. Liquidation does not need to be only for an emergency, though. It could also be a planned event using timing to maximize your end profit. Say you have plans for vacation, but you do not want vacation expenses to nibble at your financial budget for the year. You could liquidize some stocks to cover the cost of the vacation. This helps keep your budget in line for the year and can be a good reason to sell off stocks you no longer want or need, like stocks in a company you lost faith in, for instance. This illustrates how holding on to stocks you no longer necessarily want but are not actively hurting your earning potential or portfolio can benefit your finances. By this, we are referring to stocks that cut their dividends or lowered them such that they no longer make sense to keep as a dividend investor. Those stocks are now on the top of your list of potential sell stocks. Companies can lower or altogether eliminate dividends when the board of directors makes that choice. They could do this because they believe that money could be put to better use within the company through development or investing in equipment or expansion. These ventures can add value to the company as a whole and drive up the stock price in the long run. Companies that do this stand to gain a lot, but so do the stockholders. Companies can reinstate dividends at a later date once they believe they are ready to do so, and these new dividends can be valuable. Keeping an eye on what companies you own stocks in will factor into your decision. If you come to the prediction that the company will not reinstate dividends, but their stock price will increase, hold the stock. If the company will not reinstate dividends and the stock price is expected to drop and maintain that new low stock price, it might be a better idea to sell early on. Seeking advice from market experts in these kinds of matters is vital. They will be able to make better predictions than most, and if they have been correct in their predictions in the past, it would be smart to listen to them. Assuming you've been doing your research not just into single companies, but into the sectors they are from, you will have an idea of who the competition is. A good reason to sell off stocks and move on to new investment opportunities could be that the competition has grown and is taking over some of the market share that the company you have invested in once held. If this competition is strong enough and looks to take over the market share completely, it could indicate a time to sell off your shares and possibly invest in the new company. A safer way of doing this could be to have investments in both companies, or at least following the new company as if you own shares in them, applying the same kind of research and analysis as you would to any other company. You could decide to keep your original shares in the first company and still invest in the new company, which is fine. But if the old company is losing too much market share, this can indicate possible long-term weakness. A good idea to remember in your assessment of stocks to sell is reasons not to sell them. Stock prices fluctuate all the time, and sometimes when these prices drop dramatically over a very short period of time, it can be concerning. But with the power of hindsight, we can observe that these companies had their stock rise again within a month or so. This is another phenomenon to do with emotions in stock investment. Keeping emotions out of it, looking at hard data, and listening to market experts is how you will sell at the right time and make a decent profit off the stock. If a company sells a dud product or a new service they are providing is not doing as well as they had hoped, their stock price might drop. This is not a good reason to sell. The company might be working to rectify the issues and make the product or service in question better, and that will raise the stock price again. Jumping ship too early can lead to regret in the future, but holding on for too long will also lead to regret. Doing your research will determine which way the situation will play out. When to sell. Once you have made the decision to sell off certain stocks for whatever your reasons may be, the question is no longer why, but when. Judging the right time to sell takes a little practice and a keen eye. If you have a broker, then that is perfect. They will determine the best time to sell the stock to maximize the profit for your needs. If you do not have a broker, then you will need to learn some day trading skills. A key factor when selling your unneeded stocks is breaking even, getting out at least what you put in. If you bought a stock at $20 and sold it for $20, you broke even. If you sold it for $15, then you made a loss of $5. Because we are discussing dividend stocks, you can factor in how much money you have made from dividends into this equation. If you made $20 in dividends off this stock, then its selling price may not matter as much. If you only made $10 in dividends, then you would ideally want to sell the stock for at least $10 to break even. If you want to keep it simple with as few variables as possible, then you would ignore how much you have made in dividends and just look at the stock price. Waiting for the price to reach a desirable value can take a couple of days or even a week or two, depending on how quickly you want to liquidate assets. Having your trading platform or live stock chart open as you go about your day will let you see when the price is on its way up, and that is when you pick your moment. You want to sell as high as possible, but you have to be wary of getting too greedy. A trap a lot of day traders fall into is waiting too long on a stock to rise in price and missing their set price because they believe the price would keep rising. They plan to sell a stock for $20. The stock rises in price to $20, but then they decide to wait a little longer, hoping it will go up to $25 or up to $30. But then the price drops down to $18, and they have to sell, missing their mark by $2. They got too greedy and ended up making less than planned. The way to avoid this trap is with self-discipline and realistic goals. Set a price that the stock is likely to reach and stick to it. The stock might easily go above that price, but it could drop just as easily. If the stock you wish to sell is still paying dividends, it might be a good idea to wait until the nearest ex-dividend date. This will qualify you for that dividend payment. If you are not too concerned with the stock price dropping, then selling soon after the ex-dividend date will be fine. Stocks take a dip after the ex-dividend date to reflect the payment of dividends, but it is a temporary dip and is usually around the same amount as the dividend payment. The stock price will rise soon after, and that is a good point at which to sell off the stocks. If it is not urgent, then you can wait for the annual dividend to finish paying out and then sell at the end of the fiscal year. The idea of dividend investments is to get paid those dividends, so if waiting is an option, it might be worth it. Knowing how urgently you need the money is how you make the choice between waiting for the quarter or year end or selling well before those points. If the situation is urgent enough, then incurring a loss might just be a result you cannot avoid, and you can plan to recoup the loss at a later date. Always attempt to break even, but sometimes a loss is unavoidable. We do what we can to keep losses low, but sometimes we just have to take the hit. Dividend capture strategy. One strategy that could be said to be controversial is the dividend capture strategy. It has a lot of supporters and critics. The people who sing its praises claim you get the best of both day trading and dividend trading strategies, while its critics claim you cannot make enough off the back of the trades for this to be a sustainable strategy. The idea behind this trading strategy is to buy dividend stocks, hold them for a few days, and then sell them off again. This is meant to take advantage of ex-dividend dates by buying the stock before the ex-dividend date and then selling the stock on or just after the ex-dividend date. This way, the trader who sells the stock on the ex-dividend date still qualifies for the dividend payment. This is the theory behind the strategy, taking advantage of the time it takes to close the deal on stock trades. This is a popular strategy for day traders because of its turnover speed. They buy, wait a day or two, and sell. They are not concerned or interested in any of the important analysis that goes into dividend trading or the stock price itself. They believe this strategy makes a profit as they get the value of the stock back when they sell it off and make a profit with the dividend payment. No matter how small that dividend payment may be, it is still counted as profit. The reason I made sure to mention the profit being small is that in theory, this strategy should not actually work the way it is described. The stock market moves in rather odd ways that allow for strategies that do not make a lot of sense to display actual results. This is part of the reason why some people get turned away from the stock market, because it can act unpredictably. Let us get into the details and some of the math. Let's say the company A is going to pay a dividend of $1 for each stock. Each stock is worth $100. For simplicity, we are not going to go into quarterly or monthly payments. To use the dividend capture strategy, a day trader will buy the stock just before the ex-dividend date, which they then would know as it was announced on the declaration date. So they now have the dividend stock, and since they bought it in time to qualify for the dividend, they receive the $1 dividend and then sell the stock. In theory, they should now have $101. But as we know, dividend stocks tend to dip on and just after the ex-dividend date to reflect the payment of dividends. So at the time of sale, the stock should only be worth $99, meaning that the trader only has the $100 that they paid for the stock in the first place. This is the first criticism of the dividend capture strategy. In pure logical theory, the trader should not be making a profit from this deal. However, in the real world, this is not how the strategy plays out. In reality, there is a lot of time between the declaration date and the ex-dividend date. This gives traders time to watch the stock price fluctuate and buy it at a lower than average price, giving them some room for profit. Any traders that are using this strategy do not have to, and sometimes prefer not to, sell off the stock on the ex-dividend date. The stock price will be at a temporary low, which does not benefit their bottom line, so they can choose to wait a day or two and sell the stock once the price is normalized again. This is exactly how they make their profit. Sometimes the stock price does not drop in equal relation to the dividend amount, so the traders do not have to wait. They can sell off the stock immediately. These traders do not do this with one or two stocks. That would definitely not be profitable. They use this strategy with dozens of stocks spread throughout the year, making small profits off each dividend they capture, which will add up to a tidy sum at the end of it all. The extreme end of this spectrum would be doing it to multiple stocks every day, with as many stocks as the trader can keep track of. This is extremely risky, but these traders know that they have and determine that the benefits outweigh the risks. They are prepared to take a few small losses here and there because they are operating on quantity and not on individual quality. The same basic idea behind diversifying a portfolio. Apart from being an active trading strategy, another major consideration when using the dividend capture strategy is the taxes, especially in the United States. When earning an income from dividend stocks, you have to report it on your taxes. If that stock has been held long enough to be qualified dividend, it is then taxed as capital gains, 15%, as opposed to regular income tax, 22 to 35%. For a dividend to be a qualified dividend, it needs to be held for more than 60 days over a period of 120 days, starting 60 days before the ex-dividend date. For preferred stock, it is 90 days over a period of 180 days, starting 90 days before the ex-dividend date. Clearly, traders taking advantage of the dividend capture strategy do not hold stocks for that long, so they have to report their dividends under regular income tax. Some dividends are unqualified by default, which include dividends paid by real estate investment trusts, REITs, Master Limited Partnerships, MLP, employee stock options, tax-exempt companies, and savings or money market accounts. Dividends from individual retirement accounts, IRA, are also technically unqualified, but IRAs are not taxed as normal stocks. They have their own tax guides and laws that are specifically for IRAs because they are different from other forms of dividends. Chapter 5. Dividend Reinvestment Plans. One phrase that is very closely tied to dividend investments is dividend reinvestment plans, DRIP. You might see that they offer a dividend reinvestment plan as one of the benefits of investing in them, claiming you will see a greater return on your investment without having active input from you. A set-it-and-forget-it style of investment which can attract investors to the company. But let us have a look at these plans. What are dividend reinvestment plans? A dividend reinvestment plan is a plan offered by some companies to their shareholders which offers to automatically reinvest that stockholders' cash dividends back into the company and receive additional stocks. This would occur on the dividend payment date and benefits a long-term investment strategy. Different companies offer different plans, but they usually have a minimum investment requirement and offer discounts on any shares that are purchased through the DRIP. On top of the discount, these additional shares often have extremely low fees or are sometimes commission-free as they come directly from the company and do not go through any kind of middleman. And companies often allow for fractional shares in their plans. So if you can buy an additional 5 stocks through the plan, but the cash can afford an additional half a stock, that half a stock is added to any fractional stock on the next payment date. This form of investing can compound very quickly, which is why it is a very attractive form of dividend investing. At each payment date, you are earning more and more stocks, which in turn will pay out more and more dividends come the next payment date, which in turn earn even more stocks. This allows your initial investment to grow rapidly each payment date that goes by, and by the time the plan is up, you are sitting on a lot more stocks than when you started, increasing your dividend payout and exceeding what you would have been paid out had you gone with a different strategy. Starting with a DRIP can be advantageous if you do not have a lot of capital to begin investing. Starting with a few stocks, establishing the base of your portfolio, and allowing you to invest your funds at a later date once the plan is ended and starts paying out cash. This is smart for beginners because it will build capital in the long run without any money left over thanks to the option of fractional shares. You will not have small amounts of money left over from buying whole stocks. Everything is put back into the plan, getting you the most for your money. And with DRIPs being managed within the company, it helps beginners with no experience get a start, giving them time to learn how things work without the risk or emotion of stock investing. You cannot make rash or impulsive decisions because you have committed to this plan, preventing yourself from getting swept up in market activities. DRIPs can come from a few different places. The first is from the company itself. The company handles all the accounting, so all the equations and calculations that are required for the DRIP, so there are no extra fees involved. DRIPs that operate this way usually have a few conditions placed on how they operate, such as stocks, like those purchased at a discount within the company, must be sold back to the company directly, not on the open market. If a company is large enough or has a lot of investors, they might offer a DRIP that is operated outside of the company by a third-party entity. This usually does not have a lot of bearing on how effective the plan will be, as this is an outsourcing decision made by the company, and the fees are likely to be absorbed by the company as an operating expense. A company might decide to handle their plans this way if they do not have the in-house resources to handle such a high volume of calculations. The last place a DRIP can come from is through a broker or brokerage firm. This form of DRIP works differently in that the broker will reinvest dividend funds into the open market, so there are no fractional shares and it can affect the stock price if the volume of these trades is high enough. An advantage to a broker-operated DRIP is that these stocks come from the open market and can be sold on the open market. The price a company offers for shares that come from within the company can be under market value, maybe not quite at the discounted rate you had purchased them for, but under market value nonetheless. Broker-operated DRIPs offer little to no commission fees, depending on their existing relationships with the client in question, and some will not even offer a DRIP until the client has been working with them for a few years. The advantages of DRIPs are plenty, especially to beginners. First, we have the savings on commissions and fees. Because there's no middleman charging extra for their service or expertise, you save in the long run, and your expense is the initial investment into the plan. All other expenses are negated by everything being handled and processed within the company. And for broker-operated DRIPs, they need to compete with the companies, so they have to offer little to no commissions and fees on their plans as well. This makes DRIPs very cost-effective. Commissions and managing fees can easily build up, making people think twice about investing in dividend stocks. On the same point, the lack of fees makes growing your stock base as simple as it can be. Thanks to how compounding works, every quarter your stock base will grow at an accelerating rate. Compounding works based on the current total available, not an initial value. In some basic math, it would look like this. Let's say you compound 10% of available shares at the end of each quarter. Let's say you start with 100 shares. At the end of the first quarter, you will have 110 stocks. 10% of 100 is 10. 100 plus 10 equals 110. At the end of the next quarter, you will have 121 stocks. 10% of 110 is 11. 110 plus 11 equals 121. Next quarter, you will have 131.1 stocks, with fractional stocks now coming into effect. 10% of 121 is 12.1. 121 plus 12.1 equals 131.1. This math keeps going with that 10% increase in numerical value each quarter. This is the biggest point in these plans' favor, the autonomy of it all. All the growth and compounding happens without direct input from the investor. The investor gets to watch their shares grow in number and value until the dividend payout amount is satisfactory to the investor's needs. Again, this is why this form of dividend investing is so attractive to new investors. The way DRIPs work in a company's favor is as a direct source of capital. They do not have to pay out as much, if any, money to investors while they are actively participating in a DRIP. They are saving money, which allows them to use that money to grow and expand as a company. The company also gains long-term investors. An investor is increasingly less likely to pull out of an investment the longer they have held that investment. This allows the company to retain investors during harder times, such as a drop in stock price or the temporary cut of dividends. The logic being it would be better for the long-term investors to hold on to their shares while there are no dividends instead of selling them off, because they will lose the compounding growth if they come back once dividends are reinstated. The company wants loyal investors who will stick with them. They gain this loyalty through DRIPs and reducing the costs associated with investing. This is why companies offer commission-free and discounted stocks. Of course, no investment strategy is without its disadvantages, and DRIPs are no exception. The biggest one that drives investors away from these plans is the record keeping. While the process of acquiring new shares is automated within the company, it is still using your dividends. These dividends are still classified as income. You may not be directly receiving these payouts, but they are still being paid out to you and are therefore still classed as income that must be reported on your taxes, meaning that you have to keep records of all transactions. This can take a lot of time and can get complicated the more investing you do. If you invest in more than one DRIP, you have to keep records for more than one company. On the point of investing in more than one DRIP, let's talk about diversification. If you only invest in one DRIP, which you might do for simplicity, your portfolio will lose its diversity. The more stocks you have in one company, the larger the presence that the company will have within your portfolio. And the whole point of a portfolio is for your investments to be diverse so your risk is lowered. This is mitigated if one company makes up the majority of your portfolio. This will either give you pause when investing in DRIPs or give you a reason to invest in multiple DRIPs to balance out the growth of the individual plans. You can also stop this from happening by opting out of the plan once you have reached the point where you would rather have the payout than the extra shares. In order to make the best of your plans, you need to research and be informed about everything that can affect them. I will stress this point one more, and not for the last time. Research. Learn about stocks, DRIPs, REITs, different taxes that apply to specific kinds of stocks, and how companies structure their DRIPs. Do your research. Make use of multiple sources in order to verify the information you have gathered, and if it all seems in order, then act. Gathering knowledge now will pay dividends in the future, and those dividends will be actual dividends, as this knowledge is for investments. It is okay to listen to market professionals and take advice, but you have the responsibility to yourself and your financial future to verify that advice and the information they are giving you. Dollar cost averaging. When we discuss long-term investments like dividend reinvestment plans and mutual funds, Chapter 7, we might mention dollar cost averaging and how these strategies take advantage of it. Dollar cost averaging works by spreading out your purchasing of stocks over a longer time frame. This way, the average cost of your stocks remains low, as some of the purchases will cost a little more, some a little less. But by buying the stocks at the same dollar value each time you buy, the average price stays low. This strategy is as close to the opposite of the buy low, sell high mentality as you can get, because a buy high, sell low strategy just makes no sense. If you put in the same amount of money each month, then each month that amount of money will buy a different amount of stock based on how the market is performing. The benefit is you will not have to keep a close eye on the markets. You can relax a bit. Trying to maximize profits by guessing the right time to sell and buy can be very profitable, but it can be too emotional. Dollar cost averaging is an emotionless investment strategy. You invest the same amount of money no matter what the market is looking like in order for the average value of your stocks to compare positively to the cost of your stocks. This is the law of averages in effect, but not the gambler's fallacy. This is not about luck. It is about strategic planning and proven methods. Averages do need a large sample pool in order to work out in your favor. That is why this is a part of DRIPs and mutual funds. They work over a longer time frame, and the longer the time frame, the better it will end up being for you. This is the case with retirement plans such as 401k. You start investing early, and through dollar cost averaging and 30 or more years of growth, that 401k works out to have more value than cost. Thank you for buying and enjoying this book. When you get a chance, please leave a quick review for us on Audible. Thank you so much. Chapter 6. Building a Portfolio. As I've mentioned several times in previous chapters, the key to being a successful investor is having a healthy, sustainable portfolio of stocks. This is where I finally get to explain how you should go about building that investment portfolio. I'll explain in detail why that is so important to your future success, as well as any pitfalls you should avoid and how to avoid them. This is without question one of, if not the most important chapter in this book. All the information prior to this one is crucial, as each one plays a part in the bigger picture that is your investment portfolio. What is a portfolio? A portfolio is your collection of financial assets. It gets its name from the early days of investing in companies when shares and other equities were actual physical pieces of paper that stated you had a share in the company or owned that equity. Investors would keep these pieces of paper in a safe place, like in a bank or a home safe. They would frequently be put inside a portfolio to keep them in order and together for ease of use, and as time went on, investors and other industries started using the term portfolio to mean one's collection of assets. The evolution of language and the growing popularity of investments caused it to be solidified in the financial lexicon. In the modern day, it is impossible to think about the stock market or other investments without mentioning portfolios. Modern portfolios are also no longer a physical entity. An overwhelming majority of portfolios are digital and stored online in some capacity. Investors or brokers can choose to print out breakdowns of their portfolios, but the actual shares are all online in secure systems. Portfolios no longer have a definitive physical aspect, but they are arguably more important in the modern day because of how diverse investments have become, as portfolios are not limited to just stocks. A portfolio can consist of stocks, both publicly traded or privately owned shares, real estate, as indicated by title deeds in your name, valuable art you may own, and even a collection of valuable cars would be a part of your portfolio as they are an asset. There are even financial indices specifically for car collectors, not the value of car manufacturer stock, but actual car models. What assets make up your portfolio can have a massive impact on how you implement your investment strategy. Most people have an idea of what their portfolio consists of, especially if they have sought financial advice in the past. Knowing what is already in your portfolio will help you decide what your investment strategy will be because you know what you have and you know what you want to get. Based on this, you can make your plan on how to get what you want. To keep things simple, we will be referring to your stock portfolio only. This will include any stocks or investments you hold in a company. When you start building your stock portfolio, you need to keep in line with your end goals while managing how much risk you are willing to handle, also known as risk tolerance. Dividend investing requires the investor to remain calm in times of market instability. If your portfolio is healthy enough, you will not have cause for alarm and give in to panic. A portfolio is there to offer balance to an investor security in the sometimes chaotic stock market. One financial sector might be having a rough quarter, but another sector is doing very well, balancing each other out and keeping your portfolio healthy. This is the main idea behind diversifying your portfolio, which I will go into later on in this chapter. As the main point of this book is to teach you about dividend investing, your portfolio will most likely consist primarily of dividend-paying stocks, and of course, you might have a few common shares in there to round things out. When you do your research into what dividend stocks you would like to purchase, you will come across different sites offering different tools to aid in your investment. A valuable tool among these is one that can calculate what your dividend payouts will be. Having these values on hand will help when you are coming up with a budget or looking into DRIPs or just other dividend stocks to buy. You can put in what stocks you already have and stocks you are planning on buying, and these tools will show you how this will affect your income. If you want to do the calculations yourself, then using a spreadsheet program will make it as easy as possible, like Microsoft Excel, Google Sheets, or LibreOffice. Another resource will be news sites dedicated to the stock market or that report on the financial sectors in the companies you have invested in belong to. Doing your research and staying informed is how you make the most of your investments. Building a sustainable portfolio. When you start building your portfolio, there are several ways you can go about doing it. An easy method would be to do research into companies that you know. This is considered an easier option because you will already have a base of knowledge about their products and services. You know this company and you are equipped with the tools to analyze them as an investment opportunity and make a decision. The issue with this is that we want to remove as much emotion from investing as possible, and investing in companies you know and possibly trust as a consumer can become a conflict of interest when you are trying to judge the company as an investor. The same can be true on the other side of the coin. You may hate a company, but they would be a strong investment choice. The advice I would offer here would be to analyze yourself. If your emotions are too strong either way about a company, it will be best to not invest in that company because you will be unable to look at them in an objective manner. Of course, if you know a company well and are able to separate your personal feelings about them, then investing in them will be a good start to your portfolio. If the companies you know do not offer dividends, then you should do research into companies within the same industry that do. If you have knowledge about an industry or specific financial sector, you should be using it. If you know company A and B, but neither offer dividend stocks while company C does, even though they may be a smaller company in comparison, Company C could be your starting point. Do your extra research into Company C to make sure they are a safe investment showing signs of sustainable growth within their financial sector, and now you have made your start. While your initial stocks start generating dividends, you should be looking to other sectors and industries that are displaying signs of growth. This would be a good point in time to start diversifying your portfolio to increase its stability. You might start with a company you are familiar with again, then dedicate some time to research other companies that offer dividends, compare stock prices, and use the tools at your disposal to see how buying them would affect your budget and dividend payouts. Once you have made your decisions and bought your stocks, you should then move on to a different sector or industry, then another, and then another. This process of acquiring shares in different companies does not have to happen quickly. It might even be better for your budget if this process is spread over months or even a year or two. But this is the basis for building your portfolio. While you go about assessing a stock's value to your portfolio, you need to maintain your vision of your end goal. You should be buying stocks that will benefit your dividend payout through sustained growth. If a stock pays out good dividends but does not show signs of potential growth, you might need to analyze that stock more closely. Do not sell it off immediately or write it off as having no value to your portfolio, because you could use that stock and its dividends to buy more stocks that will grow. Always look at how the individual pieces can fit into the larger picture, just as you did with DRIPs. It may start off smaller than what you would want, but they grow, and with that growth comes opportunities for even more growth. Take those dividends and buy new shares in a separate company or more shares in the companies you already invested in. Bolstering your initial base of shares is as fine a strategy for growth as many others, as long as you keep an eye on how much of your portfolio they are taking up. Some tools and analytical websites can give you breakdowns on how your portfolio is looking, but you can also check this yourself. Using your spreadsheets and an office suite such as Microsoft Office, Google, or LibreOffice, you can generate a pie chart in order to visualize how balanced your portfolio is. The pie segments do not have to represent the companies you have stocks in. In the spreadsheet, you could sort and group companies by their industry or financial sector and use that modifier for your pie chart. Within each segment, you could divide it up further by each company if you would like, but we are going to keep it simple. Let us suppose that you have stocks in 4 different financial sectors: the materials sector, developing or processing of raw materials; consumer discretionaries, non-essential consumer goods; information technology, almost anything to do with modern technology; and real estate, properties and housing. Let us say that you were very careful with your investing and dedicated 25% percentage of total annual earnings of your portfolio to each sector. Let us now say that the consumer discretionary sector has begun to underperform a bit within your portfolio, but the information technology sector is experiencing some growth. The chart would, of course, change to reflect those developments, but let us suppose that your stocks in the information technology sector are performing very well. So you move some money around and sell off some stocks from other sectors to invest more in different information technology businesses. Such a high percentage of your income coming from one financial sector is usually not wise. Of course, in reality, this 70% majority could be made up of stocks from different industries within the information technology sector, in which case this would not be as serious a situation. However, for the sake of explanation, we will say that this is not the case and your portfolio is relying too heavily on the information technology sector for your income. How would you go about fixing this without selling off stock from that sector, as that would result in a loss of long-term income? The easy answer would be to not have sold off stocks from the other sectors to begin with. When we went over the idea that you could sell off stocks and reinvest in different companies, but you would want to do so in a way that keeps your portfolio balanced and healthy. If part of the consumer discretionary sector is not doing well, you should look to another industry still within that financial sector. Using the 2020 COVID-19 pandemic as an example, many stores that relied on physical store locations suffered a stock decline during the second and third financial quarters. But online stores such as eBay and Amazon barely had any issues. They experienced the dip in March but bounced back very easily, and both of their stocks are currently the highest they have ever been. One way they avoided being devastated by the pandemic and the stock market crash is that they both are e-commerce companies, so they operate under a different set of rules and market expectations. So keeping the stocks you have in the information technology sector is not a bad idea, but you would want to invest more in the other sectors now, not redistribution, but growth. Using the income from all the stocks you now have in the information technology sector, you can invest more into the sectors of your portfolio that need to be built up. Doing so means you will not have to sacrifice any stocks or earning potential, and you increase your overall income because the number of shares you own is growing. You will begin to notice over time that as you own more shares, the impact that an individual share has on the overall health and balance of your portfolio will lessen. This is a sign that you are at less overall risk with your investments. Having this safety can allow you to continue growing your portfolio into different financial sectors, thus lowering your risk even further. Do not be afraid of waiting when you are building your portfolio. If you want to start investing in a sector or industry, but you are unable to find companies that suit your plans, then simply do not invest. If you invest without being comfortable with your decision, you can get emotional about the investment. Rather, take a step back and do your research into the companies within the sector or industry. Gain knowledge, and when you know enough about them, then start investing. You do not have to invest in every financial sector available, but if you want to invest in a sector you do not understand, then do the necessary research required for you to be confident in your investment and be able to follow the conversation surrounding the companies you invested in. You do not need to be an expert in the relevant fields, but you will require a basic understanding of what it is those companies do. Importance of a diverse portfolio. Having diversity in your portfolio is what will give you the financial security you need to pursue your goals. Diversity can either be your safety net in case something goes horribly wrong with your investments, or the reason you will not be able to financially recover from something going horribly wrong. I have mentioned the importance of a diverse portfolio before, and I am sure it will come up again as we continue. But let me go more in depth for a bit. Diversifying your portfolio means you are investing in different economic sectors and industries to ensure your portfolio is sustainable, healthy, and secure. If you were to rely on a single sector too much and it was to experience a sudden decline, you would stand to lose a lot of money and potential income. If your portfolio is diverse, then if one sector underperforms during a given quarter, it will not affect you as much because the other sectors will keep the health of your portfolio stable. Once you see your portfolio growing at an increasing pace, you'll need to watch it to keep any one sector from gaining too much dominance over other sectors. When you dedicate time to building your portfolio, you can get carried away buying stocks in one sector, getting too emotional about the companies or the industry you are investing in. To keep things balanced and healthy, you will want to reach a total of between 30 to 60 stocks of roughly equal value, without any one sector taking up more than 25% of your portfolio. If one sector does go over 25% for a short period of time, less than one financial quarter, you do not need to worry. You just need to rebalance your portfolio, either by selling a few of the stocks in that sector or investing in others. Many people feel like managing a portfolio is not worth it because it takes so long to get it balanced and receive the dividends you have been working toward. They are looking for a quicker turnaround time than a dividend portfolio can offer. Building a diverse portfolio that will pay decent dividends takes time, which is what we have been preparing for. We want long-term investments that will remain safe as they pay out a dividend income. Dedicating the time needed to properly manage and research the companies you want to invest in can be hard, but it will be worth it when your properly balanced portfolio allows you to be able to live off your dividend payouts. Portfolios are the basis for many famous investors being able to live off their riches. They researched the companies, stuck to their investment plans, and kept their portfolios balanced. And balance is important. The more shares in your portfolio, the less of an impact underperforming sectors will have. However, it will increase the complexity of your portfolio, meaning you will need to put more time into managing it. Keeping your long-term goals in focus cannot be emphasized enough, and you will keep hearing it. Just like you will keep hearing that having a diverse portfolio is great, but having a balanced portfolio is better. You might find worth in having a few trading stocks in your portfolio for you to trade and make a little extra money on top of your dividends. But if your portfolio is based on trading stocks, then you would see an increase in transaction fees, and this is expected, of course. The more trades you make, the more fees you will incur. This is an important point, but the portfolio we are trying to build up is meant to have a majority of dividend-paying stocks that you are holding for a long period of time, sometimes for quite a few years. Not stocks that are traded one day to the next like commodities. Keeping those tradable stocks to a minimum in your portfolio will reduce the risk those trades will pose to the rest of the portfolio and your finances. Chapter 7. Mutual Funds. By now, you should have enough knowledge to begin building your dividend portfolio and earning a dividend income that you can grow and then live off of. But in doing your research, which I trust you have been, because I have stressed how important it is, you are likely to have come across mutual funds, and it is also likely that you notice some similarities to your goals as a dividend investor. So let me explain what mutual funds are, how they work, and point out some key differences and similarities they have to dividend investing. Knowing what other options are available will help you with your investment decisions, as you can then analyze how efficient your strategies and plans are shaping up to be. What is a mutual fund? A mutual fund is a professionally managed portfolio of assets that use capital from multiple investors to invest in various areas of the stock market. The idea is that they do all the heavy lifting by doing the necessary research, trading stocks as needed, and keeping track of all expenses and payouts. The point of a mutual fund is that the investors who put money into the fund all make money off of it without active input. This will appear very attractive to someone new to the world of investments, and it is not inherently a bad idea. You get out of a mutual fund what you put in. So, in an example, if you contribute 5% of the fund's total input, then you will receive 5% of the fund's profits, or only experience 5% of the fund's losses if things go bad. Mutual funds avoid things going bad by investing in an extremely diverse portfolio that is managed. Assets in a mutual fund can be nearly anything that can be defined as an asset. Mutual funds make their investors money by paying out dividends, which they get from any dividend stock in the fund's portfolio, by selling off shares, which would result in capital gains, which are then passed on to the investors, or by increasing the value of your position within the fund. So if you sell your position, you make more money. A point that should be explained before we get too deep into the details is that when investing in a mutual fund, no individual investor owns the stock of a company the fund has stocks in. The investors hold shares in the mutual fund, not the company. So the investors do not have any voting rights tied to those stocks. Mutual funds can be seen as an absolute middleman. When investing through a firm or a broker, you would still own the shares and any voting rights tied to them, but that requires more input from you. Mutual funds aim to remove direct input from investors to streamline the investment experience. This benefits investors because it almost completely removes emotions and emotional decision-making from investments. It is not unreasonable to see mutual funds where the investors involved do not actually know which companies their funds are invested in. Mutual funds invest in hundreds of stocks spread over most, if not all, financial sectors and industries. The investors do not need to know. The brokers in charge of managing the funds know what they are doing, giving peace of mind to the investors. Looking into mutual funds holds some value to someone looking to build an investment portfolio. You can see how the fund diversified their assets, how much of their portfolio is dedicated to which financial sectors, what index they follow, and how successful that mutual fund has been in the past. This could lead you to want to invest in the fund, and that can be fine as long as it does not stand to interrupt the plans you are already working on. I have already mentioned that doing research into what else is available to you is not a bad thing in itself as long as you do not sacrifice your plans and unbalance everything. Mutual funds are normally relatively tiny parts of a much larger investment firm. The bigger the investment firm, the more mutual funds they can have operating under them. These different mutual funds could be using different market indices to guide their choices, or they could be investing in different stock markets entirely. These small teams are usually made up of the fund manager, who usually also owns the fund. They are more than likely an investment advisor with years of experience and a proven track record within the company. The manager can hire a few extra analysts to assist in combing through the markets and finding stocks that will benefit the fund and its investors. Along with the fund manager, a fund accountant is almost always required in order to calculate the fund's net asset value per share, the NAV, which is the monetary value of your share within the fund. Mutual funds also need to make use of a compliance officer to make sure everything is within government regulations for the kinds of investments they are making. Because mutual funds operate under a larger firm, it is very common that they use the firm's compliance officers and attorneys should they need to. There are different kinds of mutual funds. Of course, there are, as I have mentioned, that one firm can have several funds investing based on different factors. So now we are going to look into the different kinds of mutual funds that exist. We have equity funds that invest mostly in stocks, as you would assume from the name. Within equity funds, they can be broken down further, as different equity funds can and do invest in different stock markets and sectors. So it would not be called an equity fund. It would be called a large cap equity fund or an aggressive growth equity fund. The kind of investment a given equity fund takes part in will be reflected in the name. This is how investment firms can have multiple equity funds under them, as each one is focusing on a different form of equity investment. Equity funds can focus on investing in different companies based on a company's market cap, concentrating solely on companies that fall within the market cap definitions that we explained earlier in the book. They can focus on an aggressive growth strategy executed over a vast number of stocks with a quick turnaround time. They can dedicate their resources to an income-focused strategy that will pay regular dividends to the fund, which will then be divided between the fund's investors. They can also be classed based on whether or not they invest in the domestic stock market or a foreign market. Equity funds span such a wide area of potential fields, I cannot give an explanation for each, but the ones I have mentioned are the ones you are most likely to come across. The next kind of mutual funds is fixed income funds. These are also known as bond funds because they invest in various kinds of government or corporate bonds or a combination of bonds and other investments that pay out a set rate of return, thus fixed income. This kind of fund is usually actively managed because the fund aims to buy what they believe to be undervalued bonds, wait for them to grow to a point they can be considered overvalued, and then sell them. This does depend on what kind of bonds the fund invests in, as different bonds carry different kinds of risks, but these funds are usually safer and more stable. The issue with bond funds is that the interest rates affect the value of the bonds they are investing in, which will in turn affect the value of the fund. A higher interest rate will mean a less valuable fund. Index funds are a kind of mutual fund that follows a market index. The idea behind these funds is that it is extremely difficult and too risky to try to beat the market in a way that generates enough profits to justify the work and to do it consistently. So they do not try to beat the market. Instead, they follow it. The fund manager follows an index such as the S&P 500, the Dow, or whichever index appeals to the fund manager, and they then purchase stocks that match the performance of their chosen index. Doing this requires less active management, has fewer people involved, uses less intricate strategies, and saves on fees, which means a better return for investors. Money market funds offer an extremely low-risk return on an investment, but the problem with low risk is low return. They invest in short-term debt instruments like government-issued treasury bills. These funds have been known to have a return only slightly better than a checking or savings account from most banks. Most investors looking for a good return on their investment tend not to invest in money market funds, but those looking for a safe bet prefer money market funds. Mutual funds do have their disadvantages, as does any method of investment, and your tolerance for the disadvantages will dictate how you invest. Mutual funds inherently have a lot of fees involved. Different kinds of mutual funds will have different fees tied to them, but all of them do have fees. It is a managed fund, and those managing the fund will charge for their services. This is expected and normal, and different funds charge different fees and rates depending on the type of fund, how many investors are involved, and the size of the team managing the fund. Together with funds, you should also be aware of what taxes you are subject to when investing in mutual funds. Some mutual funds, like 401ks and IRAs, handle taxes differently than others, and you need to be aware of this because you do not want to have to deal with improperly filed taxes. The returns you receive as part of a mutual fund will depend on how the fund is performing, so the amount you receive can change from one month to another. And there is the risk of not seeing a return at all. Of course, mutual funds do their best to avoid this happening, as they will struggle to bring in new investors if their history shows declining or non-existent returns for their investors. This fact, along with the higher than average fees experienced from mutual funds, drives some investors away because they believe the risk to be too great. Mutual funds are also at a greater risk of diluting their portfolio, meaning lower returns for the investors. This happens when a mutual fund diversifies their portfolio too much, which can occur when the fund attracts too many investors and the capital cannot be put towards sound investments. The fund's portfolio grows more unbalanced, putting the investments at increasing risk. Researching mutual funds you are expressing interest in can help you avoid a fund that could be at risk of diluting their portfolio based on their history and whether they have a limit on how many investors can invest in the fund. Differences from dividend investing. The big difference between investing in a mutual fund and standard dividend investing is the management part. When building a dividend portfolio, it will likely be you and your broker if you have one, sometimes just you. Mutual funds are you, other investors, and a team managing the fund. It is not something you invest in on your own. It is specifically designed to have multiple investors involved in it. With that comes the point about fees. Dividend investing by yourself will have almost none of the fees tied to mutual funds because mutual funds are an active form of investing with regards to the actual portfolio. In contrast, your personal portfolio will have a majority of buy and hold stocks, so you will not have to deal with excessive transaction fees. When handling your own investment portfolio, you are able to liquidate your assets if you need to. When you are investing in a mutual fund, you have no control over the actual assets, meaning you forfeit your ability to have complete control over what happens to those stocks. You are usually able to request cash from the mutual fund. Different funds handle this differently from each other. But when you do this, you will have to wait until at least the end of the trading day. Similarities to dividend investing. Even with those key differences between mutual funds and dividend investing, they do share a lot of common ground. As an investor in mutual funds, you are not doing any active investing. This is a hands-off approach for investors as the team behind the mutual fund does all the work to make sure the fund is generating profits. So the fund itself is your buy and hold stock, in a manner of speaking. And as an investor in a mutual fund, you collect dividends from the fund. These dividends act much the same as the dividends you would receive from your dividend portfolio, albeit each dividend could hold a higher dollar value than ones from your portfolio. The dividends from your portfolio come from several different companies, which you can then add up to see how much you made that quarter. With mutual funds, the dividends have already been added up and then divided between all the investors. Together with the actual dividend payouts being similar in nature, similar taxes need to be filed when receiving those dividends. Another rather obvious similarity is the diversity of the portfolios involved in dividend investing and mutual funds. The structures of both portfolios will be similar in concept and possibly in the execution. This will likely come from the fact that the best strategies for portfolio diversification can be applied to any portfolio, regardless of what kind of assets make up the portfolio. And the same kind of pitfalls will need to be watched out for. If more than 25% of the portfolio is dedicated to any one sector for an extended period of time, either something has to be done or you should look for a different mutual fund. The research and lessons you have learned thus far in dividend investing can apply when evaluating mutual funds. A lot of mutual funds also offer a reinvestment plan similar to those we discussed earlier in the book, see DRIPs. Using these plans works almost the same as those available directly from companies because you can use them to increase your position among the other investors and increase your payout when you eventually decide to opt out of the plan. So you can start at 5% and opt into the reinvestment plan, and by the end of the year, you now hold a position of 10%. This is an attractive way of getting started in the stock market as someone with no experience, giving you the opportunity to build up your investment capital while you do your research and learn as much as you can about the stock market. Chapter 8. Dividend Investing Risks and How to Avoid Them. Any form of investing carries risk. It is an unavoidable fact of the stock market. Dividend investing is usually seen as a much safer way to invest in the stock market than active day trading. And while that may be true to an extent, it does carry specific risks that need to be addressed and accepted in order to be successful at dividend investing. There are ways and methods that can help you avoid these risks to keep your investments secure. And we will look at some of the most common issues people seem to have with dividend investing. We will also tackle the reasons many people are hesitant to begin investing. Some of the following points have been addressed earlier in the book, but it is worth looking at the risks in one place as opposed to scattered throughout the different chapters. This is by no means a definitive collection of all the problems people have with dividends or investing as a means of income, but these are the excuses you will hear more than any others. You can also use this chapter as a quick reference when you need to justify a choice you're about to make about investing, whether that decision is for or against an investment, or a reason to sell off shares in a company. Short-term expectations. This point is not exactly a risk about dividend investing, but it is an issue some have with this method of investment. They do not manage their expectations appropriately. They get discouraged by the fact that they will have to wait for the investments to mature to a point they can live off them. They are looking for an easy method to get rich quick and heard that dividend investments do not require as much work as day trading, so they looked into it. But dividend investing demands careful planning and patience, which is the opposite of what they want. Your short-term expectations should be researching while you wait for your investments to grow. While you are still starting out and have made a few smaller investments, or while you are waiting for drips to help accumulate stocks, you should be dedicating some time into researching other companies and financial sectors. Ideally, you should not have short-term expectations. You should be thinking in the long term. At most, your short-term expectations should just be reinvesting and growing. People expect to be making money within a few months without working themselves to the bone, which is simply not going to happen. Day traders not only work extremely hard, but they work ridiculous schedules. They have to be aware of any and all news at all times. The trading day has an opening and closing time, but companies in other countries operate in different time zones, and they might have to keep track of how those companies are performing. This means they might have to work well before and after official trading hours. And this is after years of experience in trading in the stock market. You have to keep your expectations reasonable to your time frame, which should be very long term. If someone is unable to adjust their expectations and their plans accordingly, then they should, quite frankly, be looking elsewhere to make money. The stock market is not kind to people looking for shortcuts. Inflation and exchange rates. Anything that has anything to do with money is affected by inflation rates. This is true about the price of groceries and is true about dividend investing. When you are looking at what stocks you want to put your money towards, you do need to be mindful about how your investment will grow. If the inflation rate starts to outpace your investment growth, it will begin to eat into your returns and negate their value in your portfolio. It is not as big a risk as some other key points, but it is something to be aware of. Watching how changes in inflation are reflected in your stocks will tell you which of your investments are at risk. But if you see signs of an investment being at risk, you should not panic. You will just need to make plans to deal with the affected stocks. Keeping an eye on inflation indexes can prepare you for any changes associated with inflation. While the most popular inflation indexes are the Consumer Price Index, CPI, and the Wholesale Price Index, WPI. Inflation tends to affect cash holdings more than other forms of investing, such as dividend investing, but it does still cause changes in the market, especially if you invest in industries that work with supply and demand. More demand can push the stock price up, but because the product or service is in demand, the price is subject to price inflation. If that inflation happens too quickly, customers and consumers will look elsewhere for a better price. If the industry is dependent on a resource and that resource becomes more scarce, that will cause rapid inflation in the price of whatever that industry produces. Learning about how that specific industry handles its supply chains will be a part of your research into the companies and industries you are looking to invest in. If you have assets in your portfolio that rise in value due to inflation, it can be a good thing. You'll be making a larger profit if you decide to liquidate those assets. The downside is any buyer of those assets might not be happy about how inflation caused a price hike. Some more sinister asset holders might practice what is known as price gouging, overcharging customers or clients. This was observed in the American firearms industry in the early months of 2020 when stores selling ammunition started charging up to $1 per round of surplus ammunition. Surplus ammunition is known as being very cost-effective because you would buy it in bulk. 500 rounds per purchase in most cases, and could end up paying less than 50 cents per round. Price gouging is almost universally seen as an anti-consumer move and an abuse of inflation. But it does benefit whoever is selling the products because they experience a massive profit margin over a short time period. Related to inflation rates are exchange rates. If companies you are investing in trade on a stock market that does not use the US dollar, then you need to keep yourself informed about changes in the exchange rate and what can affect it, causing it to rise and drop, and how that will affect your dividend payouts on your share value. A way to deal with international currencies is by using a bank that supports them. This way you can receive your international currencies and exchange them when the exchange rate is in your favor, allowing you to limit any loss that could have occurred if the money was exchanged as it was paid out. Of course, dealing with international currencies comes with its own taxes and regulations that you should research before investing in international companies. If a country is showing signs of a recession or a weakening economy due to an unstable government, possible conflict, or unsustainable import-export activities, you should proceed with caution and pay closer attention to the industries you have invested in that country. Some industries thrive during certain kinds of turmoil, but things can get emotional very easily if you do not agree with how the politics in the country are shaping up. Regardless, you need to observe, study, and make smart investment decisions. Company policy changes. When you invest in a company, you are doing so because the company is looking to gain capital and stock market value. Your money benefits them, but they are not beholden to you or your money. Companies make sure that they maintain a hold on the majority of company stocks for this reason. And because a company will always act in their own best interest, you have to be aware of movements within the company. Your investment depends on their decisions, but their decisions do not depend on your investments. So when a company decides they want to change their dividend policies, you need to pay attention. You can make some predictions about company policy changes by keeping an eye on any news regarding the company and how their products and services are performing. And if the company does announce a change in how they are handling dividends, you must be prepared to make changes to your portfolio. This could mean rebalancing it or selling off the stock from that company and investing in a different company within that industry or sector. A company can change its policies based on the advice of its financial advisors and accountants. But just because the policy is changing does not mean it is changing permanently, or even that the change is for the worse. Once a change in policy has come into effect, if you believe it would be better to wait it out with the company, that is your choice and is as valid as any other decision. The key will be remaining calm and fully assessing how the policy changes will affect your long-term goals. If it will impact in a negative way, then of course you should move on to a different company or follow a different plan. But a change in policy could just as easily benefit your plans. You only need to be aware of what the company is doing, and policy changes will not catch you off guard. The allure of high-yield stocks. This is probably the second most important risk associated with dividend investing. As I pointed out in Chapter 3, high-yield dividend stocks are riskier than low-yield stocks because they indicate a lower than normal stock price. Yields are calculated by how much the dividend is compared to the stock price, so companies declare how much a dividend is going to be based on how well their stock is doing. When their stock price starts dropping, that is when their yield goes up. Something is causing their stock price to drop, and it could be something that will lead to the eventual end of the company. A stock having a high dividend yield is not an indicator of great returns on an investment. It is a warning sign that something is wrong. Dividend yields, be they high or low, should not be the determining factor in your investment decisions. High yields can appear like a good idea, but if you have been doing your research, you will know that the higher the yield, the more cautious you need to be. You need to look at dividend yield in addition to other factors, like how much the actual dividend is, the company's dividend history, any trends in the company's stock price, whether you can identify a pattern in their stock charts, whether the company is often associated with public scandals or could have a public relations disaster that will cause their stock to crash, and what the majority of other investors are saying about the company. You cannot look at only one part of a company when making these decisions, which is what people who do not know what they are doing do. They see a high yield and immediately go all in on the company and lose a lot of money in the process. They might justify their madness by claiming the method works because they do it with a selection of high-yield stocks that pay off, and losing money every now and then is just part of their strategy. That is insane. No strategy should be justifying the loss of an investment or encouraging you to only look at a single factor. High yields might look good. You are getting more money back on each dollar you have put into the company, but we are trying to achieve a sustainable income through dividends, not a short period of volatile growth chasing high yields. Be careful with your money. No matter how many times you hear people use similes and metaphors about investing in the stock market being a gamble, do not treat it as a gamble. Something having risks associated with it and it being a gamble are not the same. High-yield stocks are not a gamble, they are risky. Low-yield stocks are not a safe bet, they are just less risky. Lack of research. This could be the downfall of many investors. They do not put enough time researching the companies they invest in. Every strategy you are thinking of implementing demands research into the companies. Every individual factor that affects your investments requires research. All the famous investing geniuses of the world preach about research, and the ones who do not are not geniuses, they got lucky. You cannot rely on luck when talking about your financial security and future plans. Foregoing research and making impulsive or emotional moves on the stock market can backfire with devastating results. You have to prepare, and you have to go into each investment decision having done research on the company, on their products, and on their target demographic. If they offer a service, you need to analyze if that service will still be needed years in the future. What is the company's dividend history? Have they cut or eliminated dividends in the past? Why did they cut or eliminate them? You need to go out and find these answers to inform your choices. Collecting a set of trusted resources that you can go to in order to find answers will be invaluable in the long run. Reading market newspapers, magazines, and websites can bring insights from some of the most successful investors in the world. A few names you will become familiar with are names like the following. Yahoo Finance provides global financial news and editorials, market charts, and advice pieces. The Wall Street Journal is arguably the most famous finance news source and has been publishing since 1889, covering almost anything to do with finances. Investopedia is an all-purpose website that offers financial news, insights, reviews, and educational pieces about investing and the stock markets. Forbes has been with us since 1917 and covers a wide variety of topics that are money-related, but they focus on markets, investing, and financials. The Economist is another publication that is older than anyone who reads it. Started in 1843, they write in-depth about politics and economics and any long-term effects current events might have. Bloomberg Businessweek is a weekly publication that also covers politics, economics, and current events. Barron's, which started as a companion publication to the Wall Street Journal in 1921, has become one of the most popular publications that deal with the American stock market. The list of potential resources is nearly endless. By simply reading this book, you have proven that you are more than capable of finding resources that understand how investments work and offer sound advice. And by making it this far into the book, you have proven that you are willing to do your research. But as you gain more and more experience, you should be careful of getting lazy. You need to maintain your efforts, and you need to keep applying the same dedication to researching each potential investment. If someone rushes into an investment decision, it shows they do not know enough to have made that investment. The difference between seizing an investment opportunity and rushing into an investment decision is how much research you did prior to that point. If a company's stock suddenly becomes more available to you, and you have been researching the company and keeping an eye on their stock, then it is seizing the opportunity. If the stock suddenly becomes available and you have yet to research the company thoroughly, it is an unstable decision. You can develop a method that you consistently use to find and research companies. Your methods can evolve over time as you gain experience and find new resources. You first want to see in which sectors or industries your portfolio is lacking. This is a normal part of building and balancing your portfolio. Once you identify the areas you need to address, you filter your market charts to show companies within the sectors or industries you're looking for. Now you find the companies that pay dividends and look into how much their dividends are, what the yield is, and how their stock has been performing in recent years. You should be looking into any major news pieces about the company in recent years to see how those events affected the stock price. And if you see a rapid rise or drop in their history, you should investigate it. Learn all you can about the companies and then compare them against each other to get the most out of your money. This research will always pay out in the long term. And I will say it again, the long term is what dividend investing is about. Research counts as experience, so you'll be able to gather information more easily in the future when you need to do more research. Educating yourself on how the markets move is also research. You can never learn enough on any subject, especially a subject like investing, because it is always evolving and changing. New companies appear on the stock market and old companies collapse or get bought every year. Things can move very fast in finances, and studying what happened in the past will better equip you for the future. You should be aware of any patterns companies display in their history and make predictions based on that information. Practicing reading company movements can lead you to be able to tell when a company's stock is about to plummet and allow you to mitigate any loss that you might suffer as a result. You have to be careful, though. A bad prediction can lead to a loss. Practice your method when there is no money involved, so you do not accidentally unbalance your portfolio and end up having to scramble a plan together. Conclusion. If you have ever played chess for any amount of time, you will know that skill and careful strategy will always beat pure luck. And if you have not played chess, then please bear with me while I torture this metaphor. Skill and strategy are developed over years of study and practice. A master of his art will always beat a lucky man on the street. And just like in chess, when you are investing in companies, you have to keep an eye on the end game. All your moves, every decision has to be leading to the final frames where you have set yourself up to have an advantage. Doing so will require you to use all the pieces at your disposal. No one chess piece is more or less important to your strategy. Pawns are an extremely valuable resource to someone who has developed an efficient strategy. Do not be afraid of starting small. Starting off with a few smaller stocks and building your way up to a stable investment income is valid, as long as you stick to a plan that will make the most out of those smaller investments. Small pieces can come together to result in your success. All the biggest companies and all the most successful investors all started small, but they developed strategies and stuck to their plans. They adjusted if they needed to, but they did not sacrifice their long-term goals. The biggest takeaway from this book should be that you have to keep an eye on the larger picture. You cannot sacrifice your long-term goals for short-term gains. Be careful of anything that pushes a quick turnaround and protect your money. Do not accept unnecessary risks because you are dealing with your future well-being. There are scams and bad advice all over the internet, so verify any information you see and do your background checks on their sources. You cannot be too careful with your money, but be careful of holding back too much and losing investment opportunities. At the risk of annoying you by continuously saying this, researching and educating yourself cannot be overstated because of how important a philosophy it is. Critical thinking is a skill that is more important in the modern world than any other, and it is not limited to the world of investing. You can apply the skills you learn by researching the stock market in other facets of life. You will gain a deeper understanding of how events can chain together and have an effect on a seemingly unrelated industry. The greatest example of which would be the assassination of Archduke Franz Ferdinand of Austria in June of 1914, which started a chain of events that led to 2 wars, the likes of which we hope never to see again. Just prepare as best you can for the most likely of outcomes and have a backup plan for when things go sideways. Plans based on solid research are more likely to succeed than plans based on emotions. So do not give in to your emotional response. I'm not saying to act heartlessly, but the stock market is an emotionless industry, and you have to be able to make unbiased decisions. Stop chasing the dream, catch it.